Hey, Rebel Bankers, this is your host, Chris Noggle, and welcome back to the show. I have a special guest with me today, Michael Blank, and Michael is a leading authority in multifamily properties. So we always talk a lot about flips. We talk a lot about BRRRRs. We're going to talk about multifamilies today, but we're going to specifically focus in on raising money. Let me just tell you a little bit of extra stuff about our guest today because I'm really excited about this. He's got 2,500 units. He's an author of, how many books have you done, Michael?
Just one.
Just one. He's got the book, Financial Freedom with Real Estate Investing. I got to read that book because it looks really exciting. He's the host of a podcast called The Apartment Building Investing, and he is a specialist in raising money. So this show is all about money, and it's about your journey to becoming a rebel banker. So that's kind of what we want to start with here is we want to talk a little bit about your journey. I know real estate investing is an exciting world, but it's a world that's full of a lot of obstacles. And a lot of times when you venture into this world, you don't know really where to start. A lot of people get caught up in thinking they need all this money before they start doing multifamily investing. Today, we're going to talk a little bit about Michael's journey, how he did it, how he raises money today, and the ways he got to where he's at today so that you all can see the journey. It's always good to look at somebody where they're at, but it's always better to look at the journey and how they got there so you can then map out what the successful real estate investors are doing. And another thing too, in your journey, grab a copy of my book, The Private Money Guide. Grab a copy of Michael's book, Financial Freedom with Real Estate Investing. Those would be two good steps. You can't ever read too much. There's always going to be hidden gems in everything that you do. So with that being said, Michael, welcome to the show. And tell us a little bit about yourself and where you're at today.
Yeah, Chris, it's great to be here. Thank you so much. My background is maybe like a lot of other people. I was taught to go to school, try to get good grades and a good job, and that's what I did. I chose to get into computers, so I was actually a computer programmer when I got out. I worked some time in America Online, then joined a startup company in the late 90s and was in the right place, right time. We IPO'd in 2000, put a bunch of money in my pocket. And then in 2004, I read Rich Dad, Poor Dad. And I was like, holy moly. Like, it doesn't matter how much money you have in the bank. It matters how much passive income you have from that money. And I was like, I had like nothing. I had like interest and dividends. Like that was it. And I felt like such an idiot. So after significant hemming and hawing, I decided to throw it all away. 15 years and master's degree and 15 years in the industry, kind of built some success, some pedigree. And I decided to throw it all away and pursue this thing called financial freedom. And I can kind of consider myself the crash test dummy of financial freedom because it wasn't a straight and narrow path that I'm so very clear on today. But I mean, I did everything. I learned how to trade stocks and options. I flipped a house. I landlorded. I negotiated short sales. I got into restaurants, got into apartment buildings, and my big idea back in 2006 was to get into restaurants for various different reasons. But long story short, I subsequently lost my IPO millions in the restaurant debacle. That was my big bet on financial freedom. That failed miserably. I then clawed my way out with real estate investing. And like so many people, it's single family houses. In my case, it was flipping. At that point, I didn't have any money left. It was all deployed and or gone. So I kind of stumbled across the raising money thing. And I raised money. We had about $1 million deployed at one point. We were buying a couple houses a month. So, I read all the books. The team was in place. But after, I got into an apartment building also. And after a while, I discovered, my gosh, I'm making great money. But this house flipping thing is a lot of work. And when I sell a house, the money stops flowing. I was like, that's not really what Kiyosaki talks about in his book. Meanwhile, the apartment building is sending me mailbox money, And yes, it was exciting when I closed on it. And then I kind of forgot about it. And I was like, daggone it. That is more like what I wanted to do. The only problem is I don't really have any experience. I don't really have any money to go after this thing. But I decided then to switch over and stop doing the house flips and get more and more into apartment buildings. And having done so and having now interviewed on my podcast and written my book, I know that my belief is that the most direct path to financial freedom with real estate is with apartment buildings.
That's awesome. So Michael, let's focus in a little bit about that journey. You talked briefly about that, but let's go deeper into that. So you were at the right place at the right time. You made a bunch of money. You redeployed some of that money out there in the restaurant world. I'm not even going to go there.
Thank you. Thank you so much.
I don't really know why. Well, yeah, I feel like that's just pushing the knife in and twisting it, but no idea. But I'm glad you made it back to the real estate world where real wealth is made. And yeah, anyway, but then you kind of had to claw your way back out of that. And let's talk a little bit about those first couple deals, specifically the flips that you were kind of doing just to get yourself out of it. So let's talk about how those went, what that looked like. And then at what point did you make that transition into going after other people's money, and how did you do it?
Yeah, I mean, I got into it when I still had money, but I just kind of dabbled into it. And I actually signed up with a local mentor. He was a wholesaler. Mm-hmm. And I was like, this wholesaling business is for the birds. Like, I'm going to go all the way. I'm going to fix and flip these things. But the wholesalers, what they're really good at is they're really good at marketing. They're really good at negotiating and closing deals, which in my opinion is like 80% of it. Like fixing and selling, there's professionals for that. I can figure that out. But how do I find these deals? And that was really, really valuable to me. And that's what I learned. And the reason I did that was because everybody at your local RIA was doing wholesaling or flipping. And so I was like, well, I'm going to do that. That sounds good. I didn't really get into it until 2000, after the recession, I got into it. And it was out of sheer necessity. I needed to generate cash. And that's the only way I knew that would even remotely be able to do that. And I always, just like most people, I thought of multifamily and commercial. I took a boot camp in 2007, so I knew of it. In fact, I even started looking for deals in Texas in 2007 and put a bullet in it because I was so busy with the restaurant. So I knew of it. I knew about it. But for some reason in my mind, it was like it wasn't what I wanted to do. I wanted to generate cash now, and I also thought that I needed more money than I had access to, and I didn't have the experience. And those are two things that keep people from multifamily. And so I got into the house flipping thing, and I did raise money. But for a house flip, you got to raise maybe $100,000, which was a lot of money for me back then. And friends and family put in $25,000 each, and I had $100,000. This giant light bulb went off in my head. I'm like, holy moly! I can do something without any of my own money. I can create something out of thin air. And that was it, right? I didn't have a system like we have now. I didn't have it like dialed in like we have now. So it was just kind of the stumbling, figuring out as we go along. But it was I didn't even know that was possible. And I still to this day interview people on my podcast who now just recently discovered syndication. I was asked the question, well, what do you do differently? He goes, syndicate, raise money. Like I can do so much more. And so the idea that someone would give me money I can do stuff with was a light bulb moment for me.
Yeah. And I think I can certainly relate to that because in my humble beginnings, kind of like yours, I didn't have any restaurant exposure, but I still had some very humble stories in the beginning. I was using my own funds, and you were always self-limiting, mindset with, I have this much money, I can do this. And then when you get there, you're like, oh, guess that's it. And that didn't work out as well. And you keep thinking, I need more money. I got to do more flips to get more money to do the multifamilies. Then you had that light bulb moment where it just was like, wait a second. I can use other people's money. And it's, what's interesting about what you just said, Michael, is you started with your family, right? You started with your parents?
My wife's parents, actually. Yeah.
Oh, okay. And even better, spouse's parents.
And friends. And a lot of people don't like that, right? For various different reasons. But it's kind of where, it was my sphere of influence. I mean, that's what I have. You got to start with your sphere of influence. And it kind of grew from there. The confidence kind of grows once you have, a couple people say, yeah, I'm in. That sounds good to me. I'm like, well, shoot, maybe there's a bunch of other knuckleheads that are willing to do it.
Well, I'm going to go a little off topic here. This show, a lot of times we talk about different things, but I want to really kind of dive 2 steps deeper into that point in time when you started working with your wife's family and asking them for money, or how, actually, let's do it this way. How exactly did you approach them when you went to them with this opportunity, and how did you get them to give you money?
I think with the house flips, it's easier to raise money on the house flips because you're only holding money for, say, 6 months. You're paying them a flat interest rate, and it's guaranteed by the property. People are going to go, check. Okay, sounds good to me. It's very simple. Raising money for something like a multifamily syndication where the money is tied up for longer periods of time, it's not actually collateralized directly by the real estate. People kind of go, And typically it requires a higher investment. We have house flips here, and we did it for 25,000. With multifamily, it's minimum of 50,000, so it's a little higher. And because of that, what was interesting to me, a lot of things that I thought house flipping would prepare me for the multifamily world and didn't. One example is that my investors did not transition over at all. I had like 30 investors. Of those, like 1 or 2 went with me to multifamily. So it was yet another thing, like, oh my gosh, it didn't really prepare me at all, except for the act of raising money. But raising money for multifamily is a little more complicated, but not much more.
Mhm. Yeah. So, and that makes perfect sense. If you've had all these private investors that you built up in the flip world that were used to the short-term stuff, the 6 months, 1 year max, and then they got paid back and they had that nice warm fuzzy feeling, and that warm fuzzy feeling, and you can maybe tell me different, but that warm fuzzy feeling is usually led by, okay, do you have another deal? Like, let's do another one. Let's get this money back to work, right? That's how it is. It's like you give it back, they feel good, and then they're just like, all right, yeah, can you take it back? Can you keep?
Yeah, and then they feel, and then after that has worn off, and you say, well, I don't have a deal right now, and they sit on the money for 2, 3, whatever months. Now they're no longer so happy. So I think when I said it's easier to raise money for house flips, it's only easier because I would say I had a very high degree of comfort level with it, and that kind of transferred over to the investor. But now when you build up a comfort level around multifamily, you can explain it to people. You can explain the benefits of, talked about the Burr method earlier on, the consistent returns, or the actual compounded returns over long periods of time without any kind of volatility or lumpiness, the ongoing tax benefits you get from that investment. Once you can explain it to someone, people are going to go, that's pretty cool. Now, the only problem is they have to have $50,000. And in my case, it disqualified a lot of my friends and family investors who didn't have that kind of money. But if you can explain the benefits of that and you can make them comfortable with the investment, it's really no difference at all. It really is a reflection of your knowledge and your experience and your comfort level.
So let's talk a little bit about that then, since we're going to kind of make this episode a real special one on raising money. So we kind of talked a little bit about raising money for the flips. You're going to get those people that have the smaller investments. You can pull it together a little bit into one deal, and they're in and out. It's just a transactional thing, and it's a transactional thing for you, which sucks because it's a job. It's a hard ass job.
Who are you telling? Yeah, exactly right. It's a job.
And the mailbox money sometimes never seems to come in flipping. It's like you get the big check, and then it's like, I got money, and then it's gone. And I got money again, and then it's gone. That's exactly what it is. It's like the hamster wheel. So that's the life that we've lived until we kind of transitioned into the rentals as well. You made that switch, but you made it into multifamily. So can you, just for the audience, define what you classify as multifamily in your business?
Well, technically it's anything with 5 units and above from a lender perspective, but I classify multifamily with anything larger than 1 unit. And that includes a duplex. The only difference is the mindset of the investor who is buying the asset. So you have single family house investors who happen to buy duplexes or even quads, but it's not part of a multifamily strategy. And that's different. Versus when you buy a duplex with a multifamily strategy, your thinking is completely different. So if you have a multifamily strategy, meaning that you intend to scale your portfolio over time, what typically happens is you don't just stay with duplexes. You go for the duplex. Then the second deal typically is a 10 unit. The third deal typically is a 30 unit. And then the fourth deal is going to be 50 plus, right? So pick your favorite entry point. That's normally the progression.
Okay, so let's talk about what was your first multifamily outside of a double? Like, what was your first 10 plus unit?
Yeah, it was a 12 unit in Washington, D.C. was my first deal. And when I got into
DC.
it, yeah.
Ooh,
why does that surprise you?
Because it's an expensive market.
Well, not this area.
Okay. All right. So
I had flipped a couple of houses in this area. One of my wholesalers brought it to me, and it wasn't really part of my strategy, but I was like, oh man, I remember that boot camp I took a little while ago. Well, let me take a look at it. And it was overwhelming to me. It was only 12 units, which is dinky now in my mind, but now I was standing in front of this giant building, 3-story brick building. And the whole idea of just buying this thing just gave me the cold sweats. Then an interesting thing happened, 10 days into this. I signed the contract, sweating, biting my nails, right? And I called my investors, and they're all like, "Nah, I'm not interested in that." I'm like, "Oh crap, I have a problem." 10 days later, after having visited the property and talked to people, and all of a sudden I was like, "Man, this is a lot of work, but I wish this thing were bigger." Because my comfort zone within that 10 days grew so much that it encompassed that 12 unit and immediately went to 20 units in my mind. I'm like, man, I got this. I know this building in and out. I know the property manager now. I know some of the tenants now. I've talked to the city. My comfort zone just expanded. And it's a powerful thing about But when you get into these deals, whether you close on them or not, your comfort zone starts expanding. But that thing turned into a nightmare for me for the first 18 months. I mean, a nightmare where I literally regretted it, and I was questioning the whole thing. To begin with, I had a tenant in there. Was a professional tenant, if you know what that means. And the tenant,
I know what that means.
The landlord-tenant laws in DC are extremely favorable to the tenants, which I did not really understand until I got into this. So this one particular individual was suing me every 6 weeks for the same 12 made-up things, and was calling the city for every time a contractor walked in there. And it was difficult to navigate because the laws in DC specifically are very strict. The fines are very high, and it's very pro-tenant. So it made my life very, very difficult until the person was eventually evicted and things quieted down. And my observation since then has been that sometimes deals, especially the first deals, tend to be a little rocky sometimes, but they almost always magically right themselves with time. And it's because of this magic of real estate and multifamily. I have not met someone yet that has been sunk even by a deal that didn't go quite right, but it set them up for where they are today.
All right. So I love that. I was just going to go there. I was like, so what were your obstacles there? So you had a professional tenant, and you kind of talked about that. A professional tenant knows the rules. They know how to play the rules. I actually have one right now. In this pen, I can think of some very unique places I'd like to put this pen right now in thinking about that professional tenant. Does that ring a bell? But anyway, that's for a different conversation. So with that first 12 unit, let's go to the money side, because we kind of went to the fear side. You were scared. It was the first one you did. Then you had some issues with it. But how did you put the money together for that particular project?
So I had two of the investors, two of my 30 investors. There was my father-in-law and a friend of mine. They agreed to put in $50,000. Then I found three others just by networking. So I had five people putting in $50,000 each, or $250,000. That was enough for the down payment. We bought it for $475,000, which is cheap in DC.
That is super cheap.
Yeah, but we had to put $90,000 of work in it. We had a new roof and some renovations, and so that was enough for that. I was going to put some own money in at the time. I did have a little bit of money left, and it was going to be like my kids' college fund. I think I was going to use. It was like literally like one of my last $50,000 I had left, and I didn't have to do that. So I got into it for none of my own money as well. So it was a little bit of a struggle. I thought it would be a lot easier, but it was a little bit of a challenge. But we got it done.
So the other part was the bank, right? You went to bank funding on that one?
That's right.
Okay. Did you use a community bank, a conventional bank?
It was actually a community bank.
Okay.
The financing is surprisingly easy.
Oh, it's so easy.
It's incredible, and it's almost easier than residential. Like I don't know what your experience is, but
it's way easier than residential.
Especially if your loan balance is $1 million and above, it gets even easier. So it's a little counterintuitive. Even though I said you can get a duplex, the larger the deal is, there are certain inherent benefits of that. The problem with that is the overlap of people's comfort zone with, a 100+ unit building. It doesn't overlap. So we have to go where the person is, because I may not be able to get a person to bite off a 100+ unit for their first deal. And so before they throw up their hands going, hey, I can't do this, it's not possible, there's nothing you can say or do to convince me otherwise. Before that happens, then you do a smaller deal. Because once a person does their first deal, a magical thing happens, is a second deal follows in essentially rapid, almost automatic succession. I call it the law of the first deal in my book, and it's an incredibly pervasive phenomenon that I haven't found a single exception to the rule, which means that I can focus my resource on helping you do your first deal. Because I know once you do your first deal, it's like a giant domino that falls, and the second and third and fourth will come.
All right. And then, so with that first deal and raising the money, you went bank funding, you put together a group, a couple people, to be private investors. Are they still private investors in that deal, or did you buy them out? Or what is your exit strategy for people that you bring into a deal that might want out?
Well, it depends. In this particular one, we sold it because I was happy to get rid of it, even though we doubled our money, which was great. But it was such I basically played, worked for minimum wage at the time. But the favorite strategy is a buy, rehab, cash out, refinance, hold, right? So it's the classic Burr method, right? And we did this with a 321 unit in Memphis. We bought it for almost $7 million. We had a $4 million renovation budget, but at $1.5 million after we deployed 1.5, It is, but we only deployed 1.5 million on it, and we refinanced out at 15 million. So we returned the investors' money, to them, and now they're still owners of the building. They still get checks. And they're like, this is great.
It's the beauty of the syndication model.
It is great. So that's our favorite model is that, because I would prefer not to have to ever sell, but you can't do that when you have investors in the deal. The investors want, if you tell them you're going to get them what's called a liquidity event in year 5. A liquidity event is either a cash out refinance or a sale. Either way, they get either all or most of their money back. If you tell them that, you have to deliver that, or otherwise you lose credibility. And yes, we can sell it, but then it's a little bit like a 5-year house flip. You're like, okay, this has been a great ride, but now the money stops flowing. I don't love that. So can I refinance this and then get the investors off my back, right? Because once they have their money back, they don't really care, right? Whether they get money or money or not, or whether we hit our income numbers, they don't really care anymore. Like, we can hold on to that thing for 20 years, and they don't really care. So that's our favorite model.
So, and what you said there was pretty important. It was great for this audience to hear. Is everybody wrap your head around the BRRRR model, the flip model? Like, that's easy. It's one off, right? It's one deal. It's small. You can kind of you feel comfortable with it. But when you get into how many was that?
321 units.
321 unit deal. And it was done just like a single family house deal was done. It was basically the same strategy, just add a couple zeros. So the whole mindset, I think, is what holds people back from getting into the multifamily. Is they think that they gotta, like, it's this big giant number and it scares them, when realistically, and I know what you're saying about the banks are so much easier to deal with on multis. They like them because, hey, if you don't pay them, guess what they do? They just take an assignment of the rents and they get paid anyway. It's low risk, and they love that. It's an easy risk for them. Plus, they're getting paid for that risk because it's a bigger deal. That was a couple $1 million deal. They're getting paid for that. I mean, that's a lot of interest that they're making on that, and the fees are huge. So that's where banks love it. So if you can just learn the multifamily game, learn that money side from the bank, and you're still using just community banks, correct?
Now, these are, at this point, these are lenders, commercial lenders, and
okay, so
we try to use government-backed loan products like from Fannie Mae and Freddie Mac. They are long-term. Some of them have interest-only terms. They are non-recourse, meaning I don't have to personally guarantee them, and they're just a low interest rate. 30-year amortization. So just really, really, it's almost free money. And if once you go to sub $1 million, then it gets more difficult. You have to personally guarantee the loan. They want collateral and things of that nature. So, it's better to have a large deal. So getting loans on larger properties is actually easier than getting smaller ones. But if you're doing a smaller one, then go to a community or local bank.
Right. And it's good that I hear this, because I don't play in that space. I have multis, I've had multis, but my multis that I do are like your first couple. I mean, you're doing multi-100 unit deals, and I'm not doing them right now. So, and the reason I'm not doing them is right now I've been a huge flipper. We do a lot of BRRRRs. We have a 78, unit portfolio of singles, doubles, and quads, which is very small in comparison with yours, but nice and comfortable. But the only reason we haven't taken that next step, and we're getting prepared to do that, is I feel like the market's speculative. I feel like the price of these larger buildings, because there's so many people going after it, are very high. What is your take on the market right now, the pricing of these larger multifamily buildings? Like, what is your overall feel on that, and what do you think's coming?
So, it's a good question. I don't know what's coming. Everybody's expecting a recession only because we've been on this, bull market for so long. But there's no one really can point to a crack in the foundation or anything like that. The director of Fannie Mae actually said that he's not expecting any kind of correction at all. So I don't know what's going to come. All I can say is I'm very well aware of this. And when you're buying an environment like that, you have to stick to your buying criteria. We are seeing people overpay for things. They're putting deposits hard, sight unseen. It does remind me to some degree back to 2005. On the other hand, when you there's some lack of sophistication there, but you have to look at who some of the buyers are. Some of the buyers who are buying these are doing 1031 exchanges. They're saving millions of dollars in taxes. If they overpay by $300,000, who cares? Because they're saving $700,000 on the back end. They're foreign buyers, and they don't really care about a return. They just care about stability. So you have to look a little bit what the buyers are. That doesn't mean that you should be overpaying. It just means that you have to stick to your underwriting guidelines. And the magic happens in the off-market space, right? So if Marcus Millichap lists a deal they do a nice job marketing, and they're going to get top dollar for that. The deals that we typically see are relationship based on brokers, and they happen either off market entirely or half off market. And that's kind of where the magic happens. And so you just have to make sure that you are not compromising your buying criteria, that you're conserving your underwriting, that you put long-term debt on these things, that you always have enough cash in these deals. And so if for some reason there is a market correction, we have cash flow from day one, we have reserves, we have long-term debt, and we just ride it out.
All right. So then here's another question for you. And again, this is way off topic. We're kind of just out in no man's land for this podcast here. But what is your worst multifamily you've ever owned? Is it that 12 unit that you did, or is there one that's been worse?
No, that's probably my worst. We had the slowest start with that one. Though having said that, I had to replace my property manager during this time as well, which compounded the problem. And we've had to replace property managers before, especially if we went into a new market. A new market is always a little riskier because you don't know you're building a new team every single time. However, having been through it before, I recognize the signs of a poor property manager, and we react very quickly. Now, we'll lose some time in doing that, but the effect of the property manager is significant. So the performance and your quality of life on a poor property manager is significantly different than on the other way around. Poor property manager, you're spending lots and lots of time. You're chasing, you're micromanaging, you're not getting the collections, your expenses are high. It's like it's draining you. You're like, why am I doing this? Versus a high quality property manager, I can manage a 321 unit building with 30 minutes a week. And if I want to take a month off, I could, because I know they're going to fill it up. They're going to turn it over. They're implementing my capital expenditure plan, and life is good, right? And it's very, very easy for me to manage it. So that property manager is absolutely key. So while that was my absolute worst for a variety of reasons, we've had projects that haven't gone quite as planned. Like I said, you make some corrections and they right themselves. Because you're buying in the right market, you're buying where there's a value add opportunity, and you're just not executing it because your property manager is unable to execute it, but it's still there. Once you find someone who can, you will still then execute on value add. It just might take a little longer than you had planned in the beginning.
That was a great, like literally perfect, well said. With that, I mean, we're getting to kind of the end of this. I mean, what are a couple golden nuggets you could throw out for somebody that's getting into real estate, they've done a few deals, and they're ready to make that step into multifamily? How would they go about doing that?
Yeah, I mean, if you have something that's currently working, if you're a wholesaler or you're a landlord or flipper, you don't want to throw it out with the bathwater, number one. So stick with what's working right now, and whatever you're doing, set it up until you see it working, and then you can either put a bullet in the one or maintain both. So let me just say this is not instead of what you're doing right now. But I find that when I speak to people about this, they're like, oh yeah, this is great. I get it. That's just the best way to generate cash flow, long-term wealth. But really, it's an advanced strategy. Let me landlord for maybe 10 years. I'll buy one a year, and I'll take my experience and the money I make, and then I'll graduate to multifamily. And that's a better plan than 99% of the rest of the population. So it's not a bad plan, but it's not necessary. It's not necessary. In fact, you can bypass this. For the people who are thinking that they can bypass single-family house investing, you can. But there's two main hurdles that people can't wrap their head around. One is, I don't have $1 million to buy a building, and I don't have the experience. And with that, they're kind of dead in the water. What I discovered is that your lack of money you can overcome by raising it. We talked about that here on the show. And it's not rocket science, actually. It's not rocket science at all. It's something you can learn fairly quickly. Your lack of experience, you can overcome by educating yourself, using the right language, and by having a team around yourself. So if you know what a cap rate is and a reposition, and these words you might not know, okay, then you learn those words and you use them, and all of a sudden you sound like someone who knows what you're talking about, even though you might not. You build a team around yourself, so when you call a broker, you say, hey, I'm working with Frank over here. They manage 5,000 units in Atlanta. Frank, he's a great guy. Yeah, we closed a bunch of deals together. And now you're talking about Frank, not about you. You talk about your closing attorney, who hopefully everybody knows. So you just spend your time in the first 30, 60 days building your team, and then you hit the street with your team. And if you do that, very few people are going to look at your experience. You could align yourself with a more experienced investor, for example. You could be the hustler. You could be the guy or gal looking for deals, and you have this advisor or this partner with you, and you just reference their name constantly. And so this is how you very quickly, I mean, let's say no more than 90 days, you learn how to raise money, you build your team, and you start calling brokers. And it is amazing how brokers will take you seriously. We had a 21-year-old Air Force cadet, right? He was awarded $11 million deal. Same thing, a 25-year-old guy, never done a deal before. All of a sudden, he gets an $11 million deal as well. We have it under contract in Little Rock right now. How are these people doing it? Well, they didn't have the track record. They didn't have the money. And this is exactly how they did it. And so it's very encouraging when people find out that other people like that have done it and how they've done it. And it's much, much simpler than it might sound, looking in from the outside.
And what I find encouraging, and I'm sure the audience finds encouraging, is just listening to you talk about that. Because talking through that, explaining that, it's not as hard as people are making it up in their head. There are hurdles, but you're going to get over those hurdles. And really the best part to do is, if this is the path you want to go, you just got to take the leap. And that's what we're always talking about. We talk about our rebel bankers, and a rebel banker is just somebody that is just starting to figure out how money works, and they want to master money. And really, that's the foundation, one of the foundations for doing this. I mean, sure, you're going to have to learn how to find the deals. Michael just gave everybody a great way to do that. Build your team, and then hit the streets and start talking to brokers, and they'll take you serious.
And you talk about rebel banker, how money works, but there's other ways that people can get involved, this is why I love this space, because not everyone is going to want to be hustling and looking for deals. They're like, that doesn't appeal to me at all. I'm not even a spreadsheet guy, but maybe they're relationship people. So what happens is, hey, you know what? If I learn a little bit more about this multifamily space, I get kind of excited about it. Maybe I passively invest in a deal, right? Because people with money, they're looking, what are they going to do with the money? My return is choppy. I'm paying a bunch of taxes on it. And I don't know, something's not right with the stock market. I can't put my finger on it, but isn't there anything else? Oh yeah, there is. Multifamily syndications, right? You get cash flow, which you don't get in the stock market. Your returns are actually higher than they are in the stock market. The taxes are significantly lower, like 95% lower due to the bonus depreciation. It's incredible, right? So now I invest passively in these deals, and I get cash flow, and this is great. And I get so excited about it. I tell my friends about it. And before you know it, some of my friends are investing in deals. And now what you can do is you can become what's called a capital raiser. You can go out and actually literally align yourself with people like us, syndicators, operators, and we can joint venture together, right? So I can joint venture with you. Hey, I think I can raise $500,000 for my network. I now know what I'm talking about. I have a certain degree of confidence. I'm going to raise $500,000. Great. We're going to make you a general partner in one of our deals, and now you're a partner with us. And so what I love about it is you can get involved in this thing so many different ways, and you achieve the same exact thing: cash flow, long-term wealth, tax benefits. It's crazy.
Yeah, no, that's great. So, we're always talking, or at least when I speak, I'm always talking about the two sides of the coin. People that have money that are looking to make more money, and people that need money to make more money. Literally, this solves for both. This strategy, the multifamily space, works for people that have money that just want passive income, mailbox money. Also works for people that want to get their hands dirty, want to jump in. You can do it yourself, or you can get in as a general partner in something like what Michael's talking about here. There's just so many. That's the cool thing about real estate. It's the cool thing, but also the daunting thing is there are so many ways to make money, and there's really not a bad way. There's just your way. So all of it starts and ends with money. So you just got to master money and figure that out. Michael, if my audience wants to get in touch with you or learn a little bit more about multifamily investing, about being an investor, or about being a general partner in one way or the other, how would they get a hold of you?
Yeah, my website is themichaelblank.com. That's THE, Michael, and BLANK.com, or just Google apartment building investing. Should find me on page 1. And you can find out more about, I have a YouTube channel, podcast, blog articles. Our investment company is called Nighthawk Equity. We're at nighthawkequity.com. Or you can just click on the invest button and you'll eventually get there. So there's great ways you can learn about us. The book is also a great way to learn about the space. It's called Financial Freedom with Real Estate Investing. And it talks about some of the things we talked about on the show. How do you overcome your lack of experience, and how do you raise money? How do you actually close a deal? And then what is this law of the first deal all about? How can I use that first deal to essentially quit my job, become financially free with real estate?
That's awesome. And the other thing too, and I don't want to step out of line, but you have an event coming up, don't you?
We do. Yeah. Thank you so much.
Let's just talk about that for a second. I mean, events are always a great way, especially for people that are in the area where the event is, where they can come out, personally rub shoulders with you, shake your hand, and meet your team. So talk to them about your event.
Yeah, it's our annual event called Dealmaker Live, and it's in Dallas, July 26th and 27, 2019. And it's our annual event. We're expecting about 500 people to come. We have incredible, anyone in the multifamily space is going to be a speaker or panelist. And it's going to be a really exciting event for passive investors and active investors as well.
That's great. And if they want to get tickets for that, how would they go about doing that?
Just Google Dealmaker Live. Go Dealmaker Live. Or to Google Dealmaker Live, or go to themichaelblank.com and just click on events. That is a way to do it.
That's fantastic. Well, I'm sure the audience is going to get a ton of golden nuggets and takeaways out of this. And if they're looking for some multifamily advice, you now have it. And you guys can all get a hold of Michael. So thank you all for joining me for another episode of the Real Estate Money School. And join us for the next episode. But before you do that, make sure you get started and take the leap and just do it. Because that's the biggest thing. People are always talking about wanting to do this, but they never get off the ground. The important part is just get started. There's plenty of resources, people like Michael that can help guide you through this entire process, events, books, everything. Just leap. Thank you all for joining us for another episode. We'll see you next time. Thank you, Michael.